Hello, and welcome to our latest video chat in the Money Show Expert Interview Series. I'm Mike Larson, Editor-in-Chief at MoneyShow, and today I have the pleasure of speaking with Danielle DiMartino Booth, CEO and Chief Strategist for Quill Intelligence LLC. Danielle, thanks for taking the time out to chat with me today.
Thanks for having me. Appreciate it.
Great. Well, let's start with the most important and obvious question here. What do you think of Fed policy, and how do you see it evolving in the next few months, given what we've just heard and seen from Jay Powell and crew recently?
So I think what Jay Powell wants to do here is thread the needle. He wants to split the narrative. He wants for there to be one focus on continuing to fight inflation. And I think he wants for investors, they don't want to do it, but that's what he wants them to do, investors to separate out the banking crisis. From that, he wants to do two parallel narratives. We will focus on making sure that to stick to our financial stability mandate, they're duty bound to make sure that there is stability in the financial system. And we will separately deal with the inflation that continues by his metrics to plague the economy.
Okay. How do you think the Fed has been doing or can do in a situation like this? I mean, it really does seem like it's a very tough needle to thread there.
It is, and we're finding out exactly how that is manifesting on bank balance sheets. The Fed made a commitment to not raise interest rates early on in the transitory world, if you will. And then they came in like a bull in a china shop after Jay Powell finally got reconfirmed by the Senate. It was that long toxic wait time that really put policymakers on their back foot and caused so many of the problems that we're seeing today. I think that the Fed would have gotten off the transitory narrative and sooner onto normalizing raising interest rates had there not been the power struggle that we did see unwind at the top of the Fed. Now Lael Brainerd is gone. That's all settled. But we obviously have this massive hangover of interest rate risk sitting on bank balance sheets, as well as what we're finding out in the current in the current situation with Silicon Valley Bank finally being bought out, but only predicated on a 23% haircut on its loan book. So that's kind of, I've given you kind of what happened in theaters and what's coming to a theater near you, a 23% haircut.
Sure. And, I'm glad you brought that up, because I know in some of the recent interviews you've had, you've laid out a case that there's probably going to be more failures. This isn't an isolated one or two or even three bank situation. Can you expand upon that a little bit, and, what kind of potential fallout you think there'll be for markets there?
So I think that if going back to your first question, if Powell manages to just maintain high rates, let's just say he even pauses, there's nothing coming in early May. If he just keeps rates where they are at this high level and continues to roll off the balance sheet, shrink the balance sheet in the background, we're going to see this big March 31st Treasury maturity come off in 2 weeks' time in the Fed's H4, which is now apparently like the Super Bowl. You've got financial media live covering the release of these documents, which is wild. I mean, I follow them all the time, but now it's like it's H4 Thursday, it's H8 Friday. We're following, but as long as the Fed maintains high levels of interest rates, then the refinancing wall in commercial real estate is going to become very real, very difficult, and it's going to exacerbate the sitting interest rate risks that bonds are already contending with. In other words, liquidity is going to meet up with credit, and it's not going to be like some fun one-night stand at all.
Well, I mean, it's obvious, in the case of some of these banks, that we have interest rate risk on a very large scale, given what the Fed's done. But now, you've mentioned the other risk out there, and that's credit, right? Whether it's commercial real estate. I think also you had mentioned auto lending as being a potential flashpoint there. Can you talk a little bit more about how that's going to play out over the coming few quarters?
So auto dealerships call the period between, call it February and April, they call that Christmas, because that's typically when American households get their income tax refunds. And they take those income tax refunds, they take part of it and they pay off whatever credit card spending they might have run up over the holiday season. And then they take the rest and they go buy a new car. Well, the income tax refund season has been a bust. Yeah. And right now, auto dealerships, auto lenders, they're all starting to pull back really dramatically. They would have been doing this without a single banking failure. So this would have happened anyways, just because income tax refund season would have happened without bank failures, with that being something of a disaster. They're sitting on very much upside down inventory. The dealers paid up way too much at auction. We saw this nice pop in the Manheim index. That was dealers paying up, thinking that Christmas was coming. And they woke up and found coal in their stocking. Now they're having to deal with the fact that they paid too much for the cars, and the lenders are sitting on high loan to value used car loans from the pandemic era, and bank regulators have been told you're no longer allowed to be asleep at the switch. That moment's over. You've got crappy commercial real estate loans. You've got really crappy auto loans. Go clean up these bank balance sheets. And people have left banks alone for a very long time. Extended pretend, though, I would dare to say, is very close to being over.
Got it. In this market environment, then, if that's your backdrop on the regulatory front, the interest rate front, I mean, what's an investor to do? Are there any, is it a time for looking for safe havens? Is there something out there that looks particularly attractive to buy or sell in this environment?
Look, I mean, if you're really nimble, I mean, really, Joe, I'm in the markets every 5 minutes. Jane, I'm a day trader. Then fine. You can look back at the charts. On March the 17th, 2008, Bear Stearns fell. The market roared until May 19th of 2008 because people were like, the regulators have saved us. It's great. This is fantastic. Yeah, well, okay, that May 19th marked a high mark, but people who had the stones to be out there at the time playing that, that risk rally, they did great. Yeah. And that's fine if you can be that nimble. Of course, what happened after May of 2008. That was this little thing called Lehman. So you have to be very, very in and out trading, very capable of being so. If you're just looking for a place to park your cash at last check, one of the reasons small banks are seeing this massive $125 billion drawdown in 1 week of other deposits liabilities, ODL, my favorite liquidity metric, is because there's a bleed into money market funds that can pay you 5%. Yeah. That is we call that stupid opportunity. Anybody could figure this out.
Yeah, absolutely.
To, look for places that are still inexpensive in silver. Do your homework on your precious metals, because in times of financial crises, disruptions, if you look at what the CPI was doing in 2009, and yet gold was getting ready to go up, position yourself for the deflation that emanates naturally from credit crunches.
Got it. Anything else? I mean, I know we're about a month out now from the Las Vegas Money Show, Traders Expo. Anything that you think you might be talking about there, or a sneak peek you might want to give for anybody that's watching this video?
Gosh, I mean, I wish I could give a sneak peek of what's going to happen if this event was happening tomorrow. And that's how fluid it is. You wake up in the morning and everything has changed. So if the Federal Reserve wakes up tomorrow and they're like, you know what, we're going to say First Republic, we're going to allow municipals into this new facility, the narrative changes completely. So I wish I could see all the way through my crystal ball to a month from now. I'm just looking forward to working on my tan when I'm not on stage.
Awesome. Well, Danielle, thank you so much for your insights. I thank everyone for watching. I hope you enjoyed this. And if you did, you're going to love seeing experts like Danielle in person at our upcoming Money Show Traders Expo in Las Vegas in April. We're bringing more than 75 top speakers together for more than 100 presentations, keynotes, panel discussions, and again, hopefully some nice weather to work on those tans. So thank you for watching, and thank you for your time, Danielle.
Thank you for having me today.